Hey, it's Joshua here with another edition of Mortgage Clarity. And today we're going to tackle a question that I get a lot from my clients about whether or not it makes sense to do a cash out refi and give up my really low interest rate that I got because I did my refinance in like 2021 and just time the market and I'm down in like the low threes or high twos, whatever. But give up that rate and double that so that I can then pay off credit card debt or do a home improvement. Should we do that? So you're going to love this video. We're going to actually look at an interactive tool that I provide my clients where we make it very real to them, their numbers, their loans, everything specific to them, and they can play around with it. But we're going to do a hypothetical here so you can see just how it's not as simple of what my current mortgage rate is and what the new mortgage rate is. It's everything. So let's just take a look at this here so you can see it. So again, this is a hypothetical here. I'm not quoting interest rates or quoting actual fees. I have no idea when you're watching this video, your loan scenario, what's going on. So hypothetical, not a quote, but I would say very true to life. You can see how the tool can help and how it's not just about rate on your mortgage when trying to minimize the total expenses for your household budget. So here we have a property value is just under 580,000, loan amount of 337,000, have about 241,000 equity in the home. Now, right now, one of the benefits that Americans are experiencing who've owned a home is appreciation and equity. Last 10 years, home values have gone up almost 116%. In just the last 2 years, in 2020 and 21, you saw home values go up over 40% total. So huge equity that a lot of people have. So debt consolidation and cash out refis for home improvement are a real option for a lot of people. Now, let's take a look here. So this is just showing, we're going to start out everything being apples to apples. If you simply just refinanced, you would increase your amount because you're going to add your closing cost into that. And you'd see over here, your principal and interest payment, it's a loser. No good. It went way up. But we're going to do more than that. So stick with me. So let's just talk real quick about closing cost scenario here. So I'm showing closing costs here. These are costs that are kind of like, I think, fixed costs for a loan, kind of representing with the lender fee, title, escrow, appraisal, all that kind of good stuff, what that is for just doing a loan. Now, in addition to that, though, let's just say that at 6.25% based on this client's credit score and what the market's doing, let's say that not only is it at a higher rate, but let's just say you had to pay 2% discount fee to get that rate. So now you're really increasing this cost here. Does it make sense to still move forward? Well, again, it's not about looking at things at just the moment. It's the whole overall view of what can happen if you structure it correctly. Okay, so over here we'll see now, in addition to the house payment, which we didn't want to do that because that just went up, tax and insurance stays the same regardless if you refi or don't. But you have all this credit card debt. So for now, we're saying we're not paying off any credit card debt. So it's the same. I have our car loans. Here's my credit card debt. It's all staying the same. Here's the situation. And I'm going to increase my mortgage payment by $580 just because I refinanced. That in itself is a horrible idea. But again, it's what will we do with this equity? So I've also gone in here and set for this client saying, hey, we want to try to keep our loan to value under 75%. Now, it's possible to go up to 80% on VA loans. You can go up more than that. But I've also said, hypothetically, for this client, I set their max debt ratio at 47% because anything above that, they wouldn't qualify. But again, it'd be customized. FHA loan, you might go 55%. VA can go even way higher. So again, we'll adjust these things for the client. So as they play around, they will be alerted to if the situation got to where they're out of tolerance. Okay, so as we go through, let's just say let's pay off this credit card debt. These two are pretty high. And you can see that this number all starts to change as I click on it. So my loan amount's going up. Now my monthly savings overall is going down because I've now gotten rid of this, and the net change between my higher house payment but getting rid of this has benefited me. So if we just scroll right back up here real quick, you'll now see I have less equity in here than I did before. I have a higher payment than I did before because I've increased that loan amount, but I've got lower monthly revolving credit card debt hanging over my head. So let's just go down here and say we select everything. Now, when you select everything, we're saving almost $1,000 a month of what we're having to write in total checks. Yes, my house payment's higher, but I'm not writing any other checks to anybody else now. However, we went over our 75% limit. And we really want to stay at the 75, let's just say, because, if we can make that work, it's just a little bit better interest rate. So let's see what we can do. So we might say, well, this car loan here is an older car loan. I had a real low rate on it. Maybe I got a 0% rate when I bought it, or 1%. So let's not pay that off. And then this credit card balance is pretty small. Let's just go ahead and unclick that. And now you'll see that we don't save as much. Our payment went down because the loan size went down. And now we're inside that 75 we had $35 to spare. So great example there. Okay. So for some people, this right here, that's the big win. They simply, given what's going on in their life, they just need more of a cushion each month. It's just been stressing them out, or just been hard kind of living paycheck to paycheck. So this is kind of a way of giving yourself a $620 a month raise, so to speak. But for some of us, we can afford, and really our main concern isn't so much reducing the month to month. I want to pay off my debt as fast as possible. I want to be debt free, and I want to pay less interest to other people. So for apples to apples, what if we just took this $600 savings, dumped it back into the mortgage? What does that look like? Well, if we come down here, we'll see that over time, you actually have reduced the amount of interest you've paid in total by about $151,000 as an estimate. It's not exact, because again, you may have paid off your car loan and not replaced it. But on all this credit card debt, most people make the minimum payment. If you make the minimum payment, just look at your credit card statement. It tells you every single month. If you make the minimum payment, this is how long it's going to take you to pay off your loan. It's forever. So what we're seeing here is you actually took your current mortgage that had 28 years left on it and all that credit card debt and one car loan. And now your new loan at almost double the interest rate with those closing costs included. If you reinvest that savings into your loan, same as doing nothing, you're paying off your loan in 18 years, 8 months. You knocked off almost 10 years off your loan by doing a debt consolidation. So as you can see here, it's a powerful tool to allow you to make an informed decision. And I think the big takeaway here is you don't want to get trapped in just looking at interest rate. With all the bad news on information out there on the internet site, and how everybody just tries to get everybody's mind focused on rate, you miss the bigger picture about actually making sure you're structuring your mortgage correctly, and you're using this. It's a great financial tool, and you're using this to actually win the game overall, which is to reduce the amount of interest in total you pay each month. So yes, you're paying more interest now on your mortgage, but you're paying way less everywhere else. As you see, it's a win. So I hope you found this video helpful. Please put your comments and stuff in the video comment box down below. Be sure to like the video. Be sure to subscribe so you're alerted to others. And of course, share this with your friends and family, because again, I can't tell you how many people are actually struggling to make their monthly payments, yet they're sitting on all this equity, and if structured correctly, it can actually be a benefit. So until next time, enjoy your day, and it was a pleasure. Bye for now.